Good afternoon and welcome to another Help for Homeowners webinar session. I am Clemente Mejia and I supervise the Foreclosure Prevention Unit at the Department of Consumer and Business Affairs. This week we'll be discussing reverse mortgages. The COVID-19 pandemic has impacted many businesses and citizens across the country. Many non-essential businesses shuttered their operations due to the Safer at Home order, and unemployment rates surged near recession levels. Government officials have implemented the necessary measures to prevent mass evictions and foreclosures. Provisions of the CARES Act allowed renters and homeowners to stay in their homes without making a rental or mortgage payment if they suffered a COVID-related hardship. Since the termination of the CARES Act, the federal agencies continue to extend their moratorium on foreclosures and evictions. In February, the federal agencies extended those protections until the end of June 2021. Homeowners who currently have a forbearance plan will continue to forbear payments until the end of their term, and some may be able to extend their forbearance period for a total of 18 months. As families begin to recover from the pandemic, minorities, undocumented immigrants, and seniors are most likely to continue to struggle financially. Today, our panelists, I'm sorry, Kevin, go ahead and advance the slide. Okay, sorry about that. Our mission. The Department of Consumer and Business Affairs has been serving Los Angeles County consumers and businesses since 1976. Our mission is to promote a fair and vibrant marketplace. We serve consumers, businesses, and communities through education, advocacy, and complaint resolution. Next slide. Okay. Today, our panelists will provide an overview of reverse mortgages and how seniors may be able to use their home's equity to supplement income and relieve themselves of monthly mortgage payments. We have Ani Daftian and Chelo Jovellanos from our Foreclosure Prevention Unit. Before I turn it over to our presenters, just a reminder to please keep your mics muted and use the chat box to submit your questions. Chelo? Or is Ani, I'm sorry.
Yes, hi, I'm Lani. And just before we start our presentation, I wanted to read this disclaimer here. The Department of Consumer and Business Affairs is not a housing and urban development or HUD approved agency, and we are not certified reverse mortgage counselors. Please contact a HUD agency near you to get certified reverse mortgage counseling. This presentation is for informational purposes only. Next slide, please. On the agenda today, we will be discussing traditional versus reverse mortgages, the requirements and eligibility for a reverse mortgage. We'll discuss if a reverse mortgage is right for you, the benefits of a reverse mortgage, avoiding reverse mortgage scams, avoiding foreclosure in the process of a reverse mortgage, and at the end, we'll be going over any questions you might have. Next slide, please. So today I'll begin with a traditional pay for the purchase, and you pay it back over time. With each payment, you build your equity and your loan balance goes down. Next slide, please.
Ani?
Yes.
Sorry, I'm going to interrupt you real quick. Your sound keeps cutting out, so maybe you want to switch the video off.
Okay, I will. Thank you.
Okay.
Okay, with a reverse mortgage,
Cannot hear you, Ani.
Okay, so we apologize for the technical difficulties. It appears that Ani's sound keeps cutting out. It might be an internet-related issue. Chelo, would you mind jumping in?
Sure. Can you hear me?
Yes.
Okay, so let me continue in terms of the traditional versus reverse mortgage. So with the reverse mortgage, there is more debt and less equity. So what you can see here right now in the illustration, as more, let's say, for example, the property has already been paid off in terms of the traditional mortgage. If you have a reverse mortgage, the longer you have the loan, the larger the debt will grow and the smaller your equity in the house will be. You can keep the loan as long as you want. There's no time limit, as long as you live in the house, and doesn't matter how much you end up owing. You do own the house, you're on the title. That means you can sell it if you want. And this also means that you have to pay for property taxes, homeowners insurance, maintenance, HOA dues, condo fees, and so on and so forth. Next slide. Okay, what are the requirements and eligibility for a reverse mortgage? Here are some of the borrowers' eligibility. Homeowners who are 62 years old and older. Your home must be your principal residence. You need to live in the house for at least half of the year. You must either own your home outright or have a low mortgage balance. You may not be delinquent on any federal debt, such as federal income taxes or student loans. You should agree to set aside a portion of the reverse mortgage funds during loan closing or have enough money to pay property charges. And you must receive a counseling from a HUD-approved reverse mortgage counseling agency. Next slide. Okay, in terms of the financial assessment for lenders, the lenders will look into your income, your assets, your debts, and credit history. So just like getting a traditional mortgage, there will be an underwriting process. You will need to submit a lot of documentation for the lender to review. Also, your home, it needs to be appraised. It must be in good condition, must meet the HUD standards, according to the HECM or home equity conversion mortgage. It needs to be safe. All the basic systems are working. No damage that would make the house lose the value. If repairs are needed, borrowers may have to do some of them before closing. Next slide.
Okay, Chelo, it seems that we have Ani back in, so let's try to pass it back to Ani and see if she could continue with her portion of the presentation.
Sure.
Yes, I apologize for that. Can you hear me?
Yes, we could hear you.
Thank you. So the borrower will have responsibilities after the approval of their reverse mortgage. This includes them living in the property. They must pay their property taxes on time, maintain their homeowners insurance, keep their house in good condition so it does not lose value. Homeowners should continue paying required charges, which may include HOA dues, condo fees, anything that applies to the borrower's situation. Pay closing costs, repair the home if required by the lender, and make other payments that the lender might require. Existing mortgages with a low balance will be paid off by the funds received in the reverse mortgage. Next slide, please. Here, Chelo will be discussing how the borrower will get their money after the reverse mortgage.
Thank you, Ani. Okay, so there are 3 ways for the borrowers to receive the money. The first one is the lump sum. So this means withdrawing all available funds at once. The amount available is usually lower compared to the other options. Why? Because this lump sum payment is higher in cost because borrower will have to pay interest and fees on the entire amount. This option is also a high risk for younger borrowers for outliving their loan funds. So that means the younger the borrowers are, obviously, they will use this lump sum of money in just a shorter time. Also, lump sum does not have a credit line growth feature. Now, what is a credit line growth feature? So it is an available credit The less credit you use today, the more you'll have available for the future. So whatever you don't use in your credit line will keep growing, allowing you to borrow up to a maximum amount that is stated in your mortgage. So the amount of credit line growth is based on the interest rate and the mortgage insurance premium. So keep in mind also that lump sum also has a fixed interest rate. The next type of disbursement is the line of credit. It has an adjustable interest rate. It limits on withdrawals on the first year and then the remainder in the next consecutive years. It has a credit line growth feature, so the unused credit continues to grow. For example, the borrower did not use the line of credit, this year when he or she has been approved for reverse mortgage, the second year, but on the third year, she will have this chunk of money that he or she can borrow from the lender. The line of credit can also be combined with the third type of disbursement, which is the monthly payout. So the third is the monthly payout. It can be tenure or term. Tenure is every month you'll receive the payment as long as you live in the house, while term, it's an every month disbursement for a specific period of time that you choose, for example, 7 years. So again, this also limits on withdrawals on the first year, remainder in consecutive years. It also has a lower cost. The borrower will only have to pay interest and fees only on the money that has been drawn so far. There's a credit line growth feature. It is factored into monthly payout amount and can be combined with the line of credit. So also the money will be coming from the loan servicer, which is the company that manages the loan. And if the borrower uses up all the money, the borrower cannot get any more, but he or she can still stay in the house. And when the money's gone, it's all gone. Next slide. So what are the benefits of a reverse mortgage to our senior community? The first one is the borrowers remain the owner of the house. They are in the title of the property, so therefore they can also sell the property if they want. The second one, there are no monthly mortgage payments required from them. Even if they exhaust the proceeds or funds available to them, they don't have to make monthly mortgage payments as long as they live in the property. They are protected if the housing market declines. They may choose from the several options of disbursement as what discussed in the previous slide. And they can use the reverse mortgage to buy a new house, which is called HECM for purchase, and I'll discuss it later. Next slide. Now, during at this time of pandemic, there are some protection for those who have a reverse mortgage, since HECM or home equity conversion mortgage are insured by the FHA. Now, these benefits are available depending on the borrower situation, and it's really not typical. So for more information on these protections, please contact your HUD-approved counselor. But however, I mean, at this time of pandemic, if the seniors have this reverse mortgage, they have some type of supplemental income. They do have, they may have foreclosure protection. And if they're thinking of getting the reverse mortgage now, the interest rates are very competitive. It's low. I'll show you later how much are the interest rates right now in terms of the reverse mortgage. Next slide. Okay, so as I've said, the HECM for purchase allows our seniors to purchase a new principal residence using loan proceeds from the reverse mortgage. They can purchase these types of eligible dwellings under HECM, the single family homes, 2 to 4 unit homes with 1 unit occupied by the borrower, condominiums approved by HUD, and FHA approved manufactured homes. Now, one of the requirements for HECM for purchase is that borrowers are required down payment between approximately 45 to 62% of the purchase price. So basically, the reverse mortgage that the seniors will be getting only covers around 38 to 71%. It depends on their eligibility. Other feature of HECM, they do have repayment requirements. They have what they call flexible repayment feature, which means that the borrower can choose to repay as much or as little as they like each month, or make no monthly principal and interest payments. Also, another feature for HECM for purchase is that since HECM properties are FHA insured, it has a non-recourse feature, which means that the borrower can never owe more than the home is worth when the loan is repaid. The home is the only source of repayment, regardless of the loan balance at maturity. Next slide. Okay, so is reverse mortgage right for the borrower? So there are things to consider. One would be the costs. I don't know, but everyone knows that reverse mortgage can be kind of expensive. Like traditional mortgage loans, you will owe not just the money you borrow, but also interest and fees. But unlike traditional mortgage loans, the amount you owe grows over time. So the first type of cost here is the upfront costs. Like traditional mortgages, borrowers typically pay some one-time upfront costs at the beginning of the loan. Well, you can pay this cost out of pocket. You can actually typically choose to pay for them using your loan proceeds. So this means that the borrower doesn't need to have to bring money to the closing, but it will reduce the total amount of money that they will get to use for other things. So the upfront costs include the origination fees that cannot exceed $6,000 and being paid to the lender. Third-party costs that will be paid to real estate professionals that will assist, in getting or processing the loan, and the initial mortgage insurance premium that will be paid to the FHA. Next slide. Okay, the next would be the ongoing costs. So the ongoing costs include interest, the mortgage insurance premium, and servicing fees. These costs are charged each month. The interest rate and the MIP are calculated as a percentage of the outstanding loan balance. So as you can see in the graph here, the ongoing costs are added to the loan balance each month. And these costs do compound. So that means each month you are charged interest and fees on the interest and fees that were added to your previous month's loan balance. So the debt is really increasing. On the 5th month, you have this big debt. What more if it's like by the end of the year? So the best way to keep your ongoing costs low is to borrow only as much money as you need. Now, just to emphasize that mortgage insurance premium is actually a requirement of a HECM loan. Why? Because let's say, for example, if your heirs sell your house to pay off a reverse mortgage, your loan balance may be more than your home is worth. So that the mortgage insurance covers the remaining loan balance. So, you and your heirs won't owe more than the home is worth. And it also protects you in case your lender has financial difficulty and cannot make payouts to you as agreed. Next slide. Okay, so the final type of costs for reverse mortgage is closing costs. And this is an example of an estimated closing cost for a reverse mortgage. It's very expensive. As you can see here, the total is around $27,000. It includes document preparation, there's flood certification. Most likely this property is built where flooding is imminent. Initial mortgage insurance, or the MIP, it's $10,000, so that's very expensive. There's settlement, closing, counseling. So keep in mind, HECM counseling fee. They may charge you for it. I'm not sure if they're offering free for everyone, but here it costs $125. There's an appraisal, credit report, lender title insurance, and so on and so forth. Okay. Next slide. Okay, so this is just a pie chart to give you an idea of how much money is available for the borrower when all of the costs are, have paid. So also the borrower needs to know that there are set aside that will be required by the lenders. So in here, there are set asides for repairs of the property, and also for taxes and insurance. The borrowers also need to pay the mandatory obligations like the existing mortgage, the closing costs, the first year property taxes and insurance, if required by the lender to be paid at the closing, and other payments required by the lender. Example would be the IRS debt or student loans, etc. Next slide. Okay, so now another question would be, how much can you borrow? So your borrowing limit, which is also called the principal limit, is, the money that you can borrow on your reverse mortgage. It takes into account your age, the interest rate on your loan, and the value of your house. So as you can see here in these figures, in general, loans with older borrowers, higher priced homes, and lower interest rates will have higher principal limits than loans with younger borrowers, lower priced homes, and higher interest rates. Now, if the borrower is married and has a co-borrower, then the principal limit is based on the age of the youngest co-borrower or eligible non-borrowing spouse. Next slide. Okay, so many people are interested in a reverse mortgage. They still owe money on their home, right? They still have this traditional mortgage that they need to pay off. So if this is the situation, then, whatever you're getting on your reverse mortgage, a big chunk of that will go to pay off that traditional mortgage. But if you still owe a lot of money on your existing mortgage, you might not have enough equity to pay off your current mortgage with a reverse mortgage. And that may give you a disqualification for getting a reverse mortgage. Next slide. What happens if the borrower wants to sell their property and they have a reverse mortgage? So, maybe the senior want to downsize or move closer to the family. With a reverse mortgage, the money that you borrow and the interest and fees added to the loan balance shrink the equity. However, if home prices rise, then you might gain back some equity. So it really depends. So if the market value of your property increases, then you'll get a proceed. So as long as your reverse mortgage loan balance is less than the value of your home, then this works just like selling when you have a traditional mortgage. But keep in mind that home price increases are not guaranteed, just like what happened during the housing crisis in 2007, between 2007 and 2012. Home prices fell more than 25% or even 50% in some areas. So just be mindful of that. Next slide. Okay, so what if the borrower owes more on the reverse mortgage than the home is worth? So if the loan balance is more than the value of your home, you may not have to pay the difference. So this is where the mortgage insurance comes in. But if you don't meet your responsibilities with the reverse mortgage, let's say, you didn't you fail to pay your property taxes, or you didn't keep your property in good condition, then your loan will become due at that time. So you will usually have to sell your house for the lesser of the loan balance, or 95% of the appraised value. Next slide. Okay, so what happens to the home when the borrower passes away? When the last remaining borrower passes away, the loan has to be repaid. So most heirs will repay the loan by selling the house. So there would be like questions there, right? So the first one would be, how does it work when the loan balance is less than the home value? So your heirs will use the loan proceeds to repay the loan and keep the difference. So hopefully there's still much difference in there that they can use. How about if when the loan balance is more than the home value? Again, your heirs won't have to pay more than 95% of the appraised value because of the mortgage insurance. But keep in mind that only 5% will be covered by the mortgage insurance. The heirs need to pay still 95% of the value of the home. And obviously there's no proceed. So just a bit of caution, if you plan to, I'm talking to the borrowers here, if you plan to leave your home to the heirs, you will need to do an estate planning. So this is based on our experience here at the department we're in. We get cases that the heirs don't know what to do. They just found out that their parents got a reverse mortgage and they already passed away. They underwent the probate process, which is a tedious court process. And then at the end of the day, the property will get sold into foreclosure. So it's really hectic. It's like stressful for them. So my advice would be to have an estate planning with your heirs. Because if they want to keep the property, then they need to plan, they need to make savings to pay the loan, the full balance, or the 95% of the home's appraised value, whichever is less. Also, this loan will definitely affect your heirs. So the reverse mortgage uses up much of the value of your home as your asset. So you're spending part of it. Obviously, the lender is getting a lot of it. Your heirs will inherit less or nothing, from you. So again, I would advise to do an estate planning in terms of, when you get a reverse mortgage, please let them know. Next slide. Okay, so what if the borrower lives with a spouse or a partner? So it is a good idea and a good advice to make your spouse or partner as a co-borrower. So when your spouse or partner is a co-borrower, you are both responsible for the loan and both receive benefits from the reverse mortgage. When your spouse or partner is a co-borrower, they will be able to remain in the home after the borrower no longer lives in the home or he or she passes away. The co-borrower will also continue to receive benefits. So if there are still proceeds from, the reverse mortgage, when the borrower is not living in the property anymore or passes away. Next slide. So what if the spouse is not a co-borrower on the reverse mortgage? So remember, only co-borrowers and some non-borrowing spouses have the right to remain in the home after the borrower passes away. So if the spouse is not on the reverse mortgage, they may be able to remain in the home after the borrower passes away if they qualify under HUD's rules. So I think Ani will discuss that later. And from the time that the borrower gets the reverse mortgage, the non-borrowing spouse must continue living with the borrower to remain in the home, even after the borrower passes away. However, if the borrower got married after the borrower got the reverse mortgage, the new spouse cannot stay in the home when the borrower passes away. That's according to HECM rules. The non-borrowing spouses, they do not receive money from the reverse mortgage after the borrower dies. Okay. Next slide. Okay, now, does the borrower live with someone age 62 or older who is not, a spouse, or maybe the children? So if this person that the borrower lives with wishes to remain in the home after the borrower mover passes away, consider making them as a co-borrower so they can stay in the property. And if the person that the borrower lives with isn't a co-borrower, he or she will have to move out when the borrower, passes away or move out. Unless, this person is an heir and can either pay the reverse mortgage debt or that 95% of the appraised value with cash or a new loan. So again, I'm emphasizing to please make plans for the people that you live with. So I'm talking about, to the borrowers here for, they will need to move out after the last borrower no longer lives in the home. Okay. All right, so now Annie will discuss to you the eligible borrowing spouse. Annie?
Thank you, Chella. So an eligible borrowing spouse must be living in the home at the time the loan closes and still living in the home as a primary residence at the time the borrowing spouse passes. If they are not on title, they must secure title to the property within 90 days of the passing of the borrower. We recommend borrowers add the non-borrowing spouse back to the title as soon as the loan closes. So once the borrowing spouse has passed, the eligible spouse is already on title. The spouse will be protected for deferral and have the same responsibilities as the borrower. Next slide, please. A borrowing spouse will be considered ineligible if no deferral is granted, they do not occupy the property, they cannot get title to the home, or if they are married after the borrower has already applied for the reverse mortgage because the new spouse was not accounted for on the original loan. Next slide, please. A non-borrowing spouse is considered eligible when married to a reverse mortgage applicant who is living on the property as their primary residence, cannot access any reverse mortgage proceeds during the borrower's lifetime or after their passing if they are in a deferral period. They must be at least 62 years of age, as age is factored into the loan to value calculation on the reverse mortgage because of the deferral option they are eligible for. And they may become ineligible over time if they move out of the property during the period that the reverse mortgage is in place. So it's very important to have a reverse mortgage on your primary residence. If it is not your primary residence, then you may default and you'll be going against the regulations of a reverse mortgage. Next slide, please. A reverse mortgage has to be paid back when the borrower passes away or the last borrower leaves the home permanently, when the primary borrower moves away, or when the borrower sells the home. Next slide, please. There are other options to consider prior to a reverse mortgage. Other options include the home equity line of credit, or HELOC, refinancing your current loan, downsizing, meaning moving from the current property to a more affordable one, or lowering your monthly expenses to make your mortgage more affordable. Next slide, please. The heirs may receive nothing when the borrower passes away, so there is no monetary gain, which is a disadvantage of a reverse mortgage. Friends, relatives, or roommates living with the borrower may be forced to vacate the home if the borrower moved out of the property for more than 1 year or if they pass away, unless the friends, roommates, or relatives are also borrowers of that loan. If the borrower moves into a nursing home or an assisted living facility for more than 12 consecutive months, that is considered a permanent move under the reverse mortgage regulations. Failure to stay current on property taxes, homeowner insurance premiums, and home maintenance costs may cause lenders to call the reverse mortgage due, potentially resulting in the loss of one's home. So this is how you might fall into the process of foreclosure. Next slide, please. As a result of the economic uncertainty caused by the COVID-19 pandemic, scammers may be targeting older homeowners through reverse mortgage schemes. Below, we have listed some common reverse mortgage scams, which include a trusted family member or a caregiver coercing an elderly homeowner to apply for a reverse mortgage loan or impersonating them during the loan process. They may use an elderly homeowner's identity, social security number, or other personal information without the homeowner's knowledge to access money from the loan. They may tempt reverse mortgage borrowers to use the money to make a can't-miss investment or to take out a reverse mortgage to pay for high-cost repairs or improvements to the home. And trying to convince the reverse mortgage borrower to sign a power of attorney that gives the scammer sole access to the reverse mortgage loan is also a common scam seen during the COVID-19 pandemic. Next slide, please. So we recommend not getting a reverse mortgage just because a contractor or someone says that the best way to pay for expensive repairs or home improvements is by applying for a reverse mortgage. Reverse mortgage loan officers are not allowed to sell you investments or other financial instruments. Do not plan on buying annuity or making other investments with the money from your reverse mortgage. Money does not come from the individual loan officer who worked with you on the loan, so never sign over the loan proceeds to the loan officer. Next slide, please. Talking to a few lenders before you decide to take out a reverse mortgage is recommended because if a lender says that they are the only person you should talk to, that is a warning sign and it could be a scam. Only speak with HUD-approved reverse mortgage counselors and watch out for loan officers who try to talk to you or talk to you about borrowing more money than you want. You should never apply for more than what you can afford. It's another red flag when they advise you to stop paying your mortgage before the HECM is approved. You should not stop making your mortgage because you will default and face foreclosure. And if they are not listening to your concerns or returning your phone calls, they could be a scammer as well. Next slide, please. So foreclosure is, again, something that you might face when in the reverse mortgage process. If you were late or missed your property, paying your property charges, which include property taxes, homeowner hazard insurance premiums, flood insurance premiums, ground rents, or condominium fees or homeowner association fees. If you fail to keep your home in good repair, you did not occupy your home as a principal residence, if you as a borrower are absent from your home for a majority of a year for a non-medical reason, so for 6 months, or if it is related to a medical reason or other healthcare purposes for 12 months, you are Hello?
Yes, we could hear you, Ani.
I'm sorry, that cut off for me for a moment. So again, if you are absent from your home for more than 12 months regarding healthcare reasons or purposes, then you are going to violate the regulations of a reverse mortgage, and this will cause you to fall into the foreclosure process. Next slide, please. So to avoid foreclosure during a reverse mortgage, you want to act quickly when receiving the notice of default. The notice of default will start your foreclosure process. I would recommend contacting the Department of Consumer and Business Affairs to know what options you might qualify for to avoid foreclosure. This can include loan modifications, selling the home, refinancing the home, or a deed in lieu. If you can afford to pay your taxes and homeowners insurance, do it right away. And contact your mortgage servicer as soon as possible. Know how much taxes or insurance are due and what you have to pay. Learn what repairs are needed on your property, and know if they send any annual certification for your principal residence. Next slide, please. Listed here is information for the Department of Consumer and Business Affairs. If you are facing foreclosure or have any questions or concerns regarding foreclosure prevention counseling, you may contact us online through our website, or give us a call at our 800 number. If you have any further questions regarding a reverse mortgage, it is recommended to speak to a HUD agency. You may go online to their website to find the contact information for a HUD agency in your area. Next slide, please. We will now be taking questions from
Okay, Ani, thank you for your presentation. There was a couple questions submitted through the chat, so let me go ahead and bring them up right here. One question is, are you able to refinance back to a traditional loan to get out of a reverse mortgage years later?
I think you can, right? As long as you're paying off your reverse mortgage, you can go ahead and shop around for refinancing. But again, I mean, the caveat is that you're just getting another loan. And also keep in mind that this reverse mortgage is for 62 years old and older. So if you're converting it to a traditional mortgage, then traditional mortgage are like 15 years or 30 years. So you have to factor that as well.
Right. So technically, yes, you're able to refinance to get out. But like Cello mentioned, because of the reverse mortgage, remember you're adding on to that loan balance. So it's possible for you not to have enough equity to refinance out of a reverse mortgage. Traditionally, lenders will require you to have at least 20% equity. So depending on how much equity you use during that reverse mortgage period, it may or may not push you out of the qualification standards. So, but technically, yes, it's possible to refinance out of a reverse mortgage. Second question, what happens when the heir wants to keep the home when all the borrowers pass away?
Okay, so as what was advised earlier, if the heirs want to keep the loan in, if they want to keep the house in the future, the borrowers need to let the heirs know. So, like they've taken a reverse mortgage, and like this are the requirements. This is how much you need to pay, things like that, so they can be ready. So when they want to take it over, they have to pay off their reverse mortgage loan, or they have to pay the 95% of the appraised value of the loan if they cannot afford the full amount, because that 5% is the 5% value is covered by the mortgage insurance premium.
Great. Next question. So what happens when the borrowers do not do any sort of estate planning, meaning if they didn't prepare a will or a living trust? and they both pass away. What happens? What do the heirs need to do in this situation?
Okay, so when this happens and there's no estate planning whatsoever, the loan is due when the borrower passes away. So foreclosure will happen since the lender will, request for the payoff amount. So that's why this is very stressful for them. Usually what they do, they contact us because they do receive the notice of default and then, asking us what to do. So we will advise them to seek legal advice because they will need to undergo the probate process for them to become the executor of the estate. And then that's the only time that they have to deal or talk to the lender. And then they need to pay it off. They need to pay off the loan amount, or if they want to sell the property. So it is really stressful for the heirs to deal with it. So that's why estate planning is highly recommended.
Yes, Cello, that's a great question and answer. And even then, what heirs still have that right to pursue it and probate. They still have a time limit on when all this has to happen. So again, so if you become aware that the borrowers had a reverse mortgage, but there was no estate planning, you're going to have to act quickly because that clock could run out pretty quickly. And once it runs out, it's very difficult to get a lot of these things moving in court. So, so no estate planning generally means that the heirs have to take it to probate court, and then a lot of these things have to be sorted out in court. So it could take a long time, and it could also kind of get expensive if you don't have the means for that. So, good question, good answer, and yes, estate planning is always a good idea in these type of situations. Um, one of the attendees is asking for contact information, so it's here on the slide. Again, you can submit questions on our email, so it's homehelp@dcba.lacounty.gov. You can also call us through our 800 number, so it's 800-593-8222. Hours are 8 to 5, but our phone hours are actually 8 to 4:30. So you can call us Monday through Friday, 8 to 4:30, and we could help you with whatever questions you may have. Let's see if there's any other questions in the chat. I don't see any more. Okay. I'm sorry. There is another question. Give me 1 second. Okay, so there's a question about FHA approved manufactured homes. How do you find out more information on FHA approved parks? Okay, so good question. Again, with these type of situations, obviously it's also going to depend on your region. So we always recommend that you reach out first to a HUD-approved counseling agency, and then hopefully they could connect you to a reverse mortgage counselor, and they could help you with those steps on locating these FHA-approved parks. Again, so HUD's website here is www.hud.gov, and there'll be a link there to find a HUD-approved counseling agency. As you go through the list, it should tell you what kind of services they provide, and you should look for someone that provides reverse mortgage counseling. Okay, and I think that may have been the last question that we received. So we'll go ahead and wrap up the presentation. Okay, thank you, Ani and Cello, for the thorough presentation. If you or someone you know needs assistance or has questions about housing, foreclosure, or available resources during the pandemic, please contact the DCBA. Our services are free and confidential. Thank you and have a good evening.
Thank you.